Ledger Lifers, great to see you all once again. We have an intense week on the macro front and now we are going to talk about rising bond yields and its impact on crypto and other markets. Before I get into the details of this unraveling macro story, can I ask you all to hit the like button? Your ongoing support will help Ledger Life grow further. In this world of market dynamics, a seismic shift is underway that's causing investors to reevaluate their asset allocations. Notably, the 10-year Treasury bond yield in the US has surpassed the median cap rate for real estate investments for the first time since 2008. It's a development that's turning heads and reallocating capital, but it doesn't stop there. Even the flashy world of cryptocurrencies is feeling the tremors from the surging yields. The first casualty of this rise in bond yields is the real estate market. According to Rattle Consulting, investor purchases have plummeted by an astounding 45% this year in the US. It's a fact that can't be overlooked, particularly when it's combined with predictions of 9% to 10% mortgages by early 2024. The pullback from real estate isn't just a market correction. It's a repositioning of the asset's attractiveness vis-a-vis bonds. In fact, even in Australia, where property has often been considered a solid investment, an 11% drop in national house prices is anticipated by the end of 2023. But real estate isn't the only domain taking a hit. The cryptocurrency market, previously considered a haven for risk-on capital, is also undergoing a slump as a result of the upward swing in bond yields. A surge in yields makes bonds more attractive compared to riskier assets like cryptocurrencies. Investors, be they institutional or retail, are realizing the power of bonds in providing stable returns, which means something that's making Bitcoin and its brethren a lot less shiny. This change in bond yields is trickling down into the stock market as well. So both stocks and cryptocurrencies are considered risk-on assets. They offer higher returns but are generally more volatile. Therefore, when bond yields rise, these risk-on assets take a beating. Here is the thing though, it's not just about market movements, it's also about investor sentiment. The rises in bond yields are making investors jittery about future interest rate hikes and monetary policies. The uncertainty is palpable both in traditional markets and in the digital currency world. The crypto market, for example, reacts to even the smallest changes in bond yields, further reinforcing its vulnerability to broader financial market movements. The major hope that's keeping the space upbeat is the war in Gaza and Ukraine and the possibility of a Bitcoin ETF being announced anytime. Investors reposition assets when bond yields rise, and it isn't a mere passing phase. Historical data suggests similar patterns in the early 1980s and 2000s when bond yields surged. It reflects the cyclical nature of the financial markets influenced by macroeconomic trends and central bank policies. With nearly 60% of Bank of America fund managers predicting lower bond yields ahead, one wonders if this is a contrarian viewpoint or an accurate market prediction. The jury is still out on that. So where does all this leave us? In an economic landscape that's seeing a fundamental shift, which investors are engaging in financial calculus to weigh the merits of sticking with real estate and cryptocurrencies or switching to the newly appealing bonds. What was once a no-brainer, diving into real estate, has become a complex decision. Crypto enthusiasts are still hopeful in the light of all the development and innovation that's happening in the space, plus the uncertainty of war and the upcoming Bitcoin ETF. In this turbulent market scenario, bonds have emerged as the sirens luring capital away from what were considered lucrative assets. As we sail through these choppy investment waters, the key for survival may lie in the ability to adapt and recalibrate portfolios. Markets are fickle and conditions can change rapidly. For those with the agility to shift strategies, new avenues of opportunity are always opening up. But for now, in the battle of asset classes, it appears bonds are holding the fort and Bitcoin, although rattled, is still holding strong. And how about real estate? It's not so much. So alright folks, that's it from me today. If you have liked today's video, please don't forget to like and subscribe and leave a comment below. So see you all tomorrow, and yes, we have a report on Pivx this Friday on their new blog report. So stay safe and stay curious.
Thank you.